A single number, $40 trillion, could decide the fate of the global economy. And the most terrifying part is that this countdown reaches its breaking point in 2026. Because in that year, the world's biggest governments will face a wave of debt so massive, so unavoidable that historians may look back on 2026 as the year everything changed forever. Most people have no idea what's coming, but once you understand how we got here, you'll never look at the global economy the same way again. Imagine the entire world as a giant board game. Every nation is a player, and over the last few decades, every single player developed the same dangerous addiction: borrowing money. Debt became the magic solution for everything. Wars, stimulus, pensions, healthcare, financial rescue. A government wanted it. They borrowed for it, and for a long time, nobody worried. Debt felt limitless. It felt painless. It felt like something we could keep expanding forever. But history doesn't forget, and debt always has a price. To understand why 2026 matters so much, imagine three giant characters standing on the world stage. The United States bold, confident, and carrying the weight of global leadership. China ambitious, expanding, and hiding economic cracks that grow deeper by the day. Europe wealthy, aging, and slowly being crushed by the promises it made decades ago. These giants represent more than half of the world's economy. Their decisions shape the world you and I live in, and all three of them are walking straight into the same storm. To understand that storm, we must briefly travel back in time. Not centuries, but just a few decades. In the early 2000s, interest rates were low and money was cheap. Governments discovered the world's most addictive economic trick. Borrowing didn't seem to cost anything. It was like taking money from the future without consequences. Debt no longer felt like a burden, it felt like a superpower. And with every financial crisis, every election cycle, every global emergency, nations borrowed more and more, convinced they had found a cheat code that would never break. But every borrowed dollar has a lender on the other side, and lenders eventually start to ask the same uncomfortable question: how long can this actually last? If this story feels familiar, it's because we've lived versions of it before. In the 1690s, France borrowed heavily to fund wars until the entire economy collapsed into bankruptcy. In the late 1800s, Argentina funded a booming economy almost entirely with borrowed British money until confidence evaporated overnight. In 2008, the world believed housing prices could never fall until they did, dragging the global economy into chaos. Every time, the pattern is identical. Confidence grows, debt explodes, lenders panic, and the whole system breaks. Now back to today. From 2020 to 2024, something extraordinary happened. Governments didn't just borrow a lot of money, they borrowed more than at any moment in recorded human history. The reasons were obvious at the time. A global pandemic, emergency stimulus payments, supply chain shocks, geopolitical tensions, aging populations, and political promises no one wanted to break. In just a few years, global debt surged beyond $300 trillion. But here's the truth almost no one knows. A massive portion of this debt expires in 2026. When debt expires, it must be refinanced, essentially renewed, at current interest rates. For 2 decades, interest rates were near zero. But today, they're the highest in more than a generation. So governments will soon have to pay far more just to keep the same debt alive. Imagine having a $2,000 mortgage one day, and the next day, without warning, it jumps to $6,000. That's what 2026 looks like for nations. Now let's follow our 3 economic giants as they enter this crisis. The United States carries over $34 trillion in federal debt. A huge portion of its budget goes to Medicare, Social Security, and interest payments, and those interest payments are exploding. When U.S. debt is refinanced in 2026 at higher rates, something has to give: either taxes rise, spending is cut, or inflation increases. None of these choices are good. All of them are painful. The United States isn't collapsing, but it's entering an era where every choice feels like choosing the least bad option. China, on the other hand, has a different problem. Debt hidden in the shadows. For years, China built entire cities, massive rail networks, and huge industries using borrowed money. But many of those investments are failing. Local governments are drowning in debt, Real estate developers have collapsed. Millions of apartments sit empty. What was once seen as unstoppable growth now looks increasingly fragile. In 2026, China will confront the painful reality that debt-driven growth eventually slows, and when it does, confidence can shatter fast. Europe's crisis is quieter but just as dangerous. Its population is aging rapidly. More retirees means more healthcare and pensions. Fewer workers means less tax revenue. The gap between what governments promise and what they can actually afford is widening. Debt fills the space in between, but that space is now reaching its limit. Several European countries will hit debt levels in 2026 that once would have been unthinkable. The result won't be chaos, but it will be brutally expensive. Now we reach the breaking point, the moment at which the music in our story would turn tense. If trillions of dollars in global debt must be rolled over at higher rates, what exactly could go wrong? The first possibility is an interest payment explosion. Governments begin spending so much on interests that they have little left for anything else. Schools, roads, defense, social programs. This leads to budget cuts, slower economic growth, and rising political anger. People don't usually riot over debt, but they do riot when public services disappear. The second scenario is far more dangerous. A bond market panic. Bonds are IOUs that governments sell to investors. If investors suddenly doubt a country's ability to repay its debts, they panic. They sell their bonds. Bond prices crash. Interest rates skyrocket. This is exactly how Greece collapsed in 2010. If a major economy experienced the same panic in 2026, the shock could ripple around the world with terrifying speed. The third scenario is the most likely, a silent depression. Not a dramatic crash, not a sudden collapse, just years of grinding stagnation, higher taxes, slower growth, rising inequality, and declining confidence. A world that feels heavier, more fragile, less hopeful. The quiet crisis that bends society without breaking it. To understand what that world might look like, let's go back to a distant echo from history. The late Roman Empire. Rome didn't fall because of one dramatic event. It fell slowly over generations, weakened by too many obligations, too many expenses, too many political decisions, financed with borrowed time. Debt didn't destroy Rome directly, but it softened the foundations until one final push brought everything down. Today's global economy isn't Rome, but the pattern feels eerily familiar. Rising costs, declining labor forces, political division, and debt that grows faster than the ability to pay it. So what does this mean for the modern world? It means 2026 isn't just another year. It's a turning point, a crossroads, a moment when governments will be forced to make choices they've avoided for decades. Cut spending, raise taxes, print more money, freeze budgets, allow inflation to rise again. Every path reshapes the future. The coming debt storm looks almost identical to the moment before the 1970s inflation crisis. Governments spent heavily. Debt soared. Inflation surged, and the world spent a decade fighting economic stagnation. The parallels today are almost eerie, but there's another echo to the situation resembles Japan in the 1990s, when enormous debt, a real estate bubble, and a shrinking workforce led to decades of slow growth. The past is a map. The question is which direction the world will choose. But beneath the numbers, there's a human story. Debt is not just a spreadsheet. Debt is human behavior, hope, fear, ambition, and denial. Every government bond is a promise. Every deficit is a decision. Every dollar borrowed is a bet on the future. In 2026, that future arrives with a bill attached. And behind that bill are millions of lives. Families paying higher interest rates, governments cutting programs, businesses facing uncertainty, investors trying to protect savings. This isn't only a financial story. It's a story about what happens when societies push their limits too far. History teaches us that individuals survive crises better than nations do if they prepare. That means avoiding high personal debt, building emergency savings, diversifying investments, learning adaptable skills, staying informed, understanding how the world is changing instead of hoping it stays the same. Now, zoom out one more time. For 40 years, The world lived in a rare economic era with cheap money, low inflation, strong growth, and almost unlimited borrowing. That era is ending. 2026 marks the beginning of a new chapter 1, where the rules are different, the challenges are bigger, and the stakes are higher. Some countries will adapt, others will struggle, but no one will escape the consequences of a global debt system reaching its limits. And that brings us to the final question, the one historians may debate for decades. Will 2026 be remembered as the year the world confronted its debt, or the year the debt confronted the world? The patterns are repeating. The warnings are flashing, and almost no one is prepared for what happens next. Because the greatest risk isn't the debt itself. It's believing the storm will never arrive. The question now is simple. Are we ready?